5 minutes for questions. Mr. Secretary, you're probably familiar with the Federal Reserve report of December 2016 dealing with the Volcker rule that concluded, quote, the illiquidity of stressed bonds has increased after the Volcker rule. You may know that the director of the IMF's Monetary and Capital Markets Department provided another critique of the Volcker rule, saying that it can impact the ability of institutions to supply credit. We have a recent study conducted by the Bank of England saying in their stress simulation, material increase in spreads in the corporate bond market and in the extreme corporate bond market dislocation can threaten the stability of financial markets. So particularly as head of FSOC, what are your current concerns on the state of bond market liquidity in general, and what are your views on the Volcker rule in specific?
Chairman Hensarling, thank you very much for that question. And first, let me just acknowledge, I see you have the debt clock up here today. Hopefully, I will get out of here before it goes to $20 trillion. In any event, as it relates to your question about the Volcker rule, this is something that I do share your concerns. I think the biggest problem with the Volcker rule is its complexity and regulatory overlap. And even if it is our intent not to have proprietary trading within banks, we need to make sure that banks understand how the regulation works. Recently, I was at a G20 meeting where we had some economists that came and talked to us, and they said that every trading desk needs a psychiatrist and a lawyer to determine how to apply the Volcker rule. In any event, as my role of chair of FSOC, this is one of the issues that I am working on. I am pleased to report that we've already done preliminary work on it. The regulators also share these concerns, and we have it on our agenda tomorrow for the meeting, and we'll be addressing how we can deal with the regulatory overlap. Also, Mr. Chairman, as you do know, in our report on the executive order to the President, we've also made certain suggestions for legislative changes to that. Thank you.
Mr. Secretary, particularly those on this side of the aisle, we very much deplore what is happening to our community banks and credit unions. I know there are some on the other side of the aisle who have opined that there is no regulatory problem there. In your report, and frankly in your testimony today, you mentioned the term tailoring. Can you expound upon your views and what are you considering that you can do in the administration to better tailor rules to our community banks and credit unions?
Mr. Chairman, thank you for that question. And let me first say, we are very focused in making sure that community and regional banks can properly grow. Our financial system here, the top 8 banks account for approximately 50% of the assets in the American financial markets, and that's quite problematic. What we want to do is make sure that there is robust lending, particularly in community banks. I've met with many, many people. These are not Republicans or Democrats. These are hardworking business people, particularly in agricultural communities, particularly in small manufacturing communities, that constantly complain that the community banks are not able to lend because they are overburdened by regulatory issues. And I firmly believe that community banks know how to make loans. Let me just say they should be properly regulated, whether they're regulated by the state or the federal government. I do believe in proper regulation, but overly burdensome regulation so that community banks cannot strive is not something that is good for any of us or the American economy. So we are very focused on raising the regulatory burden, and we look forward to working with this committee on it.
Speaking of the regulatory burden perhaps on our regional banks, the Treasury report recommended raising the asset threshold for the application of enhanced prudential standards to a bank holding company, raising it from its current $50 billion threshold to an unspecified amount. It appears that Changes can be accomplished without legislation. So what do you believe the threshold should be increased to, and do we have your commitment that you will implement these changes administratively?
Sure. Mr. Chairman, let me first say my understanding is that there had been bipartisan discussions on raising this limit in the previous administration. So I would hope that those conversations continue and that this is something that we could accomplish quickly. I think that it should be raised substantially, at least to 250 or 300 billion, and I would go further saying that simple, uncomplex banks, the regulators should be able to exempt above that. And again, that doesn't mean that those banks shouldn't be regulated. Those banks will be regulated. They will be regulated by the primary regulator, and they will be regulated properly.
My time has expired.